Well, joining me now to discuss this and much more, I have the Chief Executive Officer of Cowry Asset Management Limited, Johnson Chukwu. Thank you very much for joining us on the breakfast show today, Mr. Chukwu.
Thank you for having me, David. Good morning.
Now, in analyzing this stance of the MPC in its consideration as to whether to hold, tighten or loosen, the MPC really remains concerned that the global situation looking at the Russia-Ukraine crisis and also the COVID-19 pandemic and rising prices may continue in the near term, but also may begin to moderate if deliberate and urgent actions are taken by both the monetary and fiscal authorities to correct this rising inflationary pressure. So now on the tightening area, it says in order to rein in the rising price level, MPC was of the view that given the fragile state of the GDP and also potential external and domestic headwinds from the Russia-Ukraine crisis, that would be a contradictory policy stance which would stifle the expected investment expansion. And in the case of whether or not to loosen now, the committee also feels loosening would trigger further liquidity and intensify talking about fuel inflationary pressure as available funds outstrip the economy's absorptive capacity. Now, with the heightening uncertainties we have in the local economy, do you see this as the best measure to manage inflation, especially taking cognizance of the fact that we have a fragile economy and the energy crisis? Your take on this?
Yes, David, I agree with the 6 members of the MPC that voted to hold on the rates. As it stands today, we are dealing with diametrically opposite pressures on the economy. And some of them are exogenous factors that cannot really be curtailed by either increasing rates or reducing rates. But let's start from endogenous factor. That's the internal factors to us. We've seen a gradual moderation in our economic recovery. If you cast your mind back, in the second quarter of last year, GDP grew by 5.01%. Of course, we talked about the base effect. The third quarter, it grew by 4.01%. That's a decline from the 5.01%. It grew by 4.03%. And then in the fourth quarter, it grew by 3.98%. So you see a consistent decline in growth rate because the base effect is moderating, which means we can't say the economy is actually growing at a robust rate, which means if you take any measure that will contract credit to the economy, then you could see a further reduction in the GDP growth rate. Remember that even the GDP growth rate we witnessed, we are partly influenced or induced by some of the expansionary monetary policies and fiscal policies of the government, including intervention policies of the central bank, like the Development Finance Initiative of granting sub-market rate interest rates to the manufacturing sector at those who are accessing CBN windows. They were getting 5% interest rates. So that is part of the factor that led to the recovery of the economy. Then if you tighten, you are going to see a situation where liquidity will be sucked out of the economy, cost of funds will go up, manufacturing activities will further slow down, and the economy could tip back to a recession or a decline. Then on the other side, on the converse, we are seeing inflationary pressure that are partly not endogenous to us. We've seen the Ukraine-Russian war leading to disruption in supply chain, further to the disruption we have already witnessed from COVID-19. And we've seen that lead to a spike in inflation rate across many countries. We've seen situation where price of stable commodities like wheat has increased. We've seen price of energy prices like fuel, crude oil, gas, natural gas have all increased across the globe. So you are seeing that pressure being transferred to commodity prices in the country. And that's why if you look at the inflation figure in February, you realize that the increase in inflation was largely as a result of increase in core inflation. So we saw a core inflation of above 14% in the month of February. That led to overall increase in inflation rate to 15.7%. So this factor, so you have to look at, do I tighten so as to fight inflation, but at the same time tip economic recovery into the negative, into the recession? Or do I loosen to further stimulate economic activities and take the risk of exacerbating inflationary pressure? Beyond inflationary pressure, we're also dealing with FX pressure. I saw in the newspaper reviews this morning that there's an article that said that parallel market rate is about 590 naira to $1, and that manufacturers are already complaining that it could affect manufacturing activities. So that fact alone, which simply means that if you loosen, you are going to force liquidity into the FX market, and that could lead to a further pressure on the exchange rate. Unfortunately for us, as a country, we are not enjoying the benefit of increase in crude oil price because we are not able to produce even to our open quarter. So we are dealing with major contradictions in the economy.
And now, talking about some of the contradictions we are facing now, what do you make of the stance of the progression of an interest rate hike by the U.S. Federal Reserve Bank and also the Bank of England? Now, they have their own policy direction which they're tilting towards. Now, in terms of contextual response to global economic shocks, now, central bank governors have to tailor their fiscal and monetary policy solutions with the greatest of intent now to mitigate the impact of all of these external shocks. Now, I've been told that we'll have to take a quick break, but we would like to have your thoughts on this when we come back after the short break. Please don't go anywhere. Thank you very much for still staying with us. We are looking at the reactions which have followed the Monetary Policy Committee of the Central Bank of Nigeria stands to retain all parameters unchanged. And I have with me Johnson Chukwu, the Chief Executive Officer of Cowry Asset Management Limited. Thank you very much for still staying with us. Now, before that break we took, we're looking at the stance of the U.S. Federal Reserve as well as the Bank of England. Now, we've also had this policy direction where it is a major issue in terms of rate hikes. Now, do you think Nigeria can mimic such an attempt? And now, for the fact that both economies, taking cues from them, are interconnected to the global financial market, hence global flows are also expected to experience some downturn and be exacerbated by some of the sanctions which we have from the Russia-Ukraine crisis. At this point in time, how do you see Nigeria position itself favorably? Because it doesn't seem like we have a clear-cut idea around this.
Okay, let's start from the U.S. Federal Reserve Bank that increased interest rates by 25 basis points. If you look at the factor that we are not expecting that the U.S. Federal Reserve Bank will increase interest rates in their March meeting, and even before the Russia-Ukraine war, because we've seen a consistent increase in inflation rate in the U.S. The U.S. inflation rate is at a 40-year high at 7.9%. They've not seen anything like that for a generation. And that's why everybody expected that the Federal Reserve Bank will step on the gas, lift its leg on the gas pedal. Step on the gas pedal to slow down, the brake pedals to slow down the speed at which the U.S. economy is recovering. And one of the factors that you have to recognize in the U.S. case that the supply disruption from China, occasioned by COVID, majorly affected a consumer nation like the U.S. So we have a demand-supply imbalance in the U.S. Just like have in several other Western countries. Of course, we also knew that should the U.S. Federal Reserve Bank increase rates, which they did in the month of March, that the British Bank of England and the European Central Bank will also increase rates. Because if they don't, we're going to see flow of liquidity move away from Western economy, Europe and Britain to the U.S., where return on such money market instruments will improve. And then this factor will be further exacerbated by the war in Ukraine, which has led to further supply chain disruption, so increase in major commodity, what I mentioned earlier, price of gas, of course, we know Russia is the largest exporter of natural gas in the world, and they are actually feeding the entire Western countries. So there was a trade that gas supply could be cut off, and then you saw a spike in the price of LNG, liquefied natural gas, which has all transmitted across the consumer price index globally. So these factors have made it more compelling for the world central banks or major economic central banks to increase interest rates. The questions you ask are, can Nigeria isolate itself from these increases? I doubt, because like economy is also interrelated to the global economies. We're also seeing this transmission or trickle effects of these increases. Price increases across the globe coming to the country. I had mentioned the issue of inflation rate, that the core inflation for the first time increased faster than the rate of food inflation in the country in the recent past, which was largely attributed to disruptions in supply chain and increase in imported items. Okay. So at some point, we have, as a country, the Monetary Authority may also consider increasing interest rates in the country.
Thank you so much for your time on the Breakfast Show this morning. It's been a pleasure speaking with you, Johnson Chukwu. We've been speaking with the Chief Executive Officer of Cowry Asset Management Limited. Definitely we'll keep our fingers crossed. The MPC sees a domestic outlook going by the available data on key macroeconomic indicators suggesting the likelihood of some subdued output growth for this year. We'll keep our fingers crossed and see how the intricacies will play out. Thank you once again for your time on the Breakfast Show.